A very good afternoon to ladies and gentlemen. Welcome to another FSM1 event where we help investors invest globally and profitably. Thank you so much for attending the webinar today. Our topic of the day is the real rally is just beginning, how to capture under the radar under opportunity in Japan. And we have Mr. Alexander Hart, product specialist for Sumitomo Mitsui DS Asset Management. Before the webinar begins, allow me to give a brief introduction to Mr. Alexander. Mr. Alexander has 8 years of industry experience in relationship management and product management, with a particular focus on Japanese and global equity. Prior to joining Sumitomo Mitsui DS Asset Management, he spent 3 years at Asset Management One as a product manager with the global sales department based in Tokyo, where he was in charge of EMEA institutional clients. He has also held the role of product specialist with the global sales team at Sompo Asset Management. Mr. Alexander obtained a BA from the School of Oriental and African Studies, University of London, and is fluent in Japanese. Without further ado, let us welcome Mr. Alexander.
Hi, thank you for that, Elise, and good evening to everybody. My name is Alexander Hart, and I'm with SMDAM Sumitomo Mitsui DS Asset Management, based here in Tokyo. And it's my pleasure to speak to you tonight about what I think is, well, has been, in my opinion, since I came to Japan about 10 years ago, has been, potentially one of the most exciting areas in the equity market, and that is Japan. And this year, I think that the global investor audience, I would say, helped on by Warren Buffett, as well as some other positive factors, that we've got going for the stock market at the moment. I would say that, the world is waking up to the reality of Japan. And I want to talk about some interesting ideas that we have at the firm in order to, I would say, exploit the situation for equity investors and to enjoy, sustainable and long-term returns from the market going forward. So I really want to start off with kind of an outlook on the market, what our firm sees as the main drivers going forward for the equity market, what is moving, more in the short term, and also talk about how we are positioned in the fund in order to be able to benefit from that. So I'll move on to the presentation. And so the first message really, I think, for our audience today is, in our view, the real rally that we've seen start earlier this year. We saw the headline Nikkei index, for example, the primarily kind of blue chip large cap index here in Japan, up 20% year to date. That's in local yen terms. And we've also seen, a similar situation in whereby Japanese equities have rallied versus global stocks, I would say 3 times in fairly recent history. So this chart is about, just exploring what, the similarities with the current situation was during the previous 2 rallies, as well as what, maybe are some of the structural changes that have happened in Japan that are going to, in our view, make this current rally even more sustainable than the previous 2. So if we look at the first, highlighted part of the chart there on the left, this is a time in the Japanese market where it's just after essentially the recapitalization of the banking system. So there was, bad debt essentially from the bubble era, culminating in the bubble bursting in 1990. This was really, resolved in the early 2000s, and there was a lot of optimism in the market. I would say characterized by, hope for policies such as deregulation, as well as, rebuilding essentially the banking system going forward. And we saw, Japanese equities outperformed versus global equities during this period from 2003 to 2005. So this was really policy expectations. And then if we look at 2012, this may be, I would say more recognizable to our listeners on the call today. This is Abenomics, is frequently referred to as Abenomics. So the previous Prime Minister of Japan, Shinzo Abe, essentially, again, policy expectations. So unleashed 3 sets of policies aimed at, I would say, galvanizing a sustainable recovery in the Japanese market, ending deflation, as well as, boosting the equity market. It was very successful in the short term. We saw a lot of buying, particularly from foreign investors. But I think, as things often do in Japan, things really, the developments were too slow for some investors to, I would say, be able to come to terms with in the market. And so even though we saw on the policy side, great improvements were made in terms of the corporate governance structure, for example, in Japan. So companies are not only becoming more profitable, they're actually sharing more of that with shareholders. We saw the rally kind of fizzle out as tangible results really didn't appear in terms of stronger levels of profitability, et cetera, in companies that were readily visible to the global equity investors. And the weak yen, I think, in a way, is in some way to blame for that. So if we look at the final part of the chart on the right, this is the current situation. So the real main difference between this time and the previous 2 rallies is that this is not driven by policy expectations. There is supportive fiscal stimulus as well as monetary stimulus and an ongoing, I would say, supportive monetary policy in Japan for the equity market. But the reason why the market's outperforming at the moment is not policy expectations. It's actually economic expectations for the country of Japan itself. So things that we haven't had for a very long time here, such as inflation, higher wages, strong consumption. What maybe I would say probably a lot of our listeners today have probably visited Japan recently. We also have huge inbound tourism here. We have a lot of positives for the domestic economy. So the domestic economy has typically been a very anemic economy, and that was no different really during the last 2 rallies. What we're seeing now is real change in terms of the top line GDP, and we think that combined with the corporate governance reforms that we've also seen, equity investors are well positioned in order to be able to benefit from this going forward. So that is the main message really of today's presentation. In the near term, I think there are 3 main supporting factors for the Japanese market, which the first is pent-up demand. So this is primarily domestic consumption. Japan, as I'm sure many are aware, opened a lot later than other countries around the world post-COVID. And so really the full reopening of the country has only got into full swing, I would say, in the last kind of quarter, the last 2 quarters. So May of 2023 is when the last kind of pandemic era restrictions, particularly on the mask wearing, were lifted, and the country was truly opened up. And since then, we've seen Japanese consumers are spending, and we've also seen the return of inbound travelers. We're up to 80% of the levels achieved in 2019, which was a historical high in visitor numbers to Japan, and they're also spending more money as well. And we also have, I'm sure great news for many of our listeners today, an extremely weak yen at the moment. So a yen close to 150. So it means, and particularly, I think my friends from the UK, our contacts when we go to Asia are in some ways delighted to learn that things are essentially on sale in Japan. So it's really boosting consumption in terms of both Japanese consumers here, as well as by introducing healthy, moderate level of inflation through price pressures, which have now translated into wage growth, and we're looking to see real wage growth going forward, as well as for the visitors here able to buy particularly luxury items, etc. In the long term, I think there are some really exciting features as well of the market. So the first is really the end of deflation. So Japan, we talk a lot about the lost decade. Some people even call it the lost decades. So 3 decades where essentially GDP nominal growth went nowhere. It means prices and wages were stagnant. So people are, were still being paid the same that they were making essentially in 1990. Things still cost the same. And, for us on the ground here, we're seeing this really start to change. Yes, with personal consumption, so private consumption, people, I would say enjoying their higher levels of wage growth versus recent history. So we had the wage growth of about 3.7% this year, which is historically back to the levels not seen since 1990. But we're also seeing on the corporate side something we look, obviously, as an asset management company, we meet many different companies, a lot of them in the small cap space that we'll talk about later today. And we're really seeing a different approach to pricing strategy now in the Japanese market, much more, I would say, rational approach to what has been seen before. There's a lot more pressure from shareholders now on setting sensible management KPIs. So Japan typically would have, things like sales growth, market share as the primary KPIs. Now we're seeing more of a drive towards looking at margins, looking at profit growth, and pricing strategy is obviously an important part of that. So I think that's an interesting development we're seeing at the moment. Another point is massive capex. So we're seeing investment by firms here in Japan building new plants. The semiconductor industry is probably the most famous, I would say, example of that. But we also have a lot of construction going on in the adjacent industries as well as the the auto sector. Now, the final point is corporate governance reform, and I'll talk about more about that in a minute. So the first slide really is just this is the our forecast at SMDAM for GDP for Japan. So Japan actually released the latest GDP figures last week, 6% annualized in terms of real GDP, so very strong, driven primarily by exports, but also robust in terms of consumption as well as capex. I think the main message here, rather than the real GDP, in fact, is probably the nominal GDP. So this is essentially the price levels in the economy. It's showing that inflation is making its way into the economy, and we think that a positive cycle of prices and wages, and again, essentially continuing that sustainable positive cycle is what the country needs going forward. So if we look at the next chart, we see ample room for recovery still remaining in Japan versus other markets. If you look at the chart on the left, we have shown personal consumption expenditure for services versus other markets, including the US and Germany. And you can see that Japanese levels, whilst having recovered nicely, I would say, particularly coming into 2023, are still slightly below 2019 levels. So there's still room for consumers to spend. And in fact, just a personal anecdote, the number of tourists has certainly increased in Japan, when we go out, when we go to a restaurant, etc. But we also had the kind of annual summer holiday season just a couple of weeks ago, and I went on the bullet train, absolutely packed with both visitors to Japan as well as local Japanese. I flew recently in the airport. The security line was probably one. I've never seen it so big, to be honest. So I think that even these kind of anecdotal pieces of observations from the ground really suggest that I think we're seeing a strong recovery driven in the country, certainly relative to what we had for the last 3 years. And I hope that many of our listeners have either already come to Japan or are looking to do so in the near future. If we look at the chart on the right as well, it shows the personal savings rate. And so you can see that the green line is Japan there. You can see during the pandemic, a lot of, I would say, excess savings on top of what consumers typically saved prior to the pandemic. So we have a stock of unused savings that's built up, and that is also fueling the pent-up demand. So our fund is more focused on the long-term structural and secular kind of growth stories in the economy, but these short-term trends are also beneficial for both the fund as well as the economy. And we do have, some, I would say, exposure in the fund as well to names benefiting from the reopening trend as well here in Japan. So this is just another slide just to add some more color about reopening. So inbound travelers, if you look at the levels in 2019, we had 30% of the travels in 2019 came from mainland China. So mainland China just opened up the group tour, removed the restrictions on group tours, I think last week or a couple of weeks ago. So despite not even having that benefit, and again, the Chinese domestic economy has a different set of challenges to what it had in 2019. But we're already at 80% level of tourist numbers in Japan, even without the mainland China tourists. I think the number from China at the moment is about 5% or so. So I think it's really only upside for the economy, when we do see some contribution from that cohort going forward, particularly through the Chinese holiday in September. So spending also is on the rise. This chart only captures up to 2023, but by capita, spending by inbound tourists is up, 20% on 2019 levels. And again, the weak yen is a tailwind for this point. So the next slide, we've just plotted the recent movements in the currency. The currency is highly correlated to the gap in interest rates between Japan and the US. So Japan essentially controls its interest rates by controlling the 10-year. It's been, it was modified slightly the other day to allow a bit more fluctuation, but still a large gap between the US and Japanese rates. So US being over 4% now. We're looking at about a 3% ish gap between Japanese and US interest rates, and that's keeping the currency cheap. So I guess that's the good news for anyone who's planning to travel to Japan maybe a bit later in the year. We're not expecting the currency to move too much. I think at the firm we think in the near term, Japan is unlikely to do anything drastic with the interest rate. The focus in Japan is really on maintaining the momentum that we have in the economy at the moment, on capitalizing on the opportunity to break the deflationary cycle, and we don't see any major action from the Bank of Japan that would cause the yen to appreciate in the near term. Maybe in the next couple of years we may see the yen strengthen, but for the moment it's a cheaper yen. And so cheaper yen is it benefits exporters, but it also benefits it benefits members of our portfolio. We do hold a number of companies that I'll be talking about a little bit later in the conversation that that operate very successfully in the global market, occupying critical mission critical areas of supply chains such as semiconductors, as well as the EV value chain, and are in some cases even misunderstood or missed completely by the market just due to their size and the pure number of companies in the Japanese market. Over 3,000 of the listed companies are actually smaller companies. So if we look then at the longer term trends, which I think are the most interesting from our perspective here at the firm when we think about the fund. The first point is the idea of perennial deflation in Japan, the mindset that has created. I originally come from the UK, and I can tell you that from experience, it's a totally different environment. Essentially, consumers have or had no incentive to spend. They were incentivized to save because prices would ostensibly be lower going forward. And the really important thing is it's not just consumers, it's actually the companies that cater to that consumer demand. So consumers makes up about 50% of GDP, so a really important force in the economy. And the corporate sector essentially has to cater, they have to capture that demand. So there was massive underinvestment in Japan in the corporate sector. And we saw instead of that, huge cost cutting with globalization of supply chains and foreign direct investment, really focused on kind of protecting I would say the margins of companies as opposed to forward-looking investment. That is really changing now. We can talk about more some specific examples of that going forward, but I think that there are some signs now that we really could see 1 or perhaps 2% higher inflation on a sustainable basis going forward in Japan, and you can see that's reflected in the chart there on the left, which is the consumer expectation of inflation. And I'm aware that our listeners and quite rightfully may ask, so how is this good for Japan? Inflation, and the rest of the world is battling inflation. Japan, the central bank is doing very little about it. We understand that we have this deflation. We want to conquer this deflation, but isn't inflation just going to derail the economic recovery in Japan? And the theory there could be, for example, import inflation, particularly energy prices, etc., food prices. And indeed, the last bout of inflation, primarily in 2022, we did see cost push inflation, but it's now through mostly the services industries. So the I would say the lower paid sectors in the economy, we're actually seeing more flexibility in the wage levels, which is leading to more consumption. So we're seeing this inflation filter through cost push inflation to indeed demand pull. So it's actually kind of in a way creating demand, and that's what I think is really unique about the Japanese situation versus the rest of the world. If we look at this next page, another I would say anemic issue in the Japanese economy has been wages, and wages are really just the flip side of the prices. In fact, it's really all the same coin if you think about it. So you have wages, you have the price level in the economy, and then you have investment. And if one of those, 3 factors is failing, then I think that essentially it's like a chicken and the egg situation. So inflation, I think the main message here is the moderate levels of inflation that we're seeing in Japan at the moment are actually a positive for the economy. And, we've seen wage growth here in the country as well. If you look at the chart on the left, the orange chart shows the level of wage growth achieved in 2023. And you can see that it's much, it's on par with levels not seen since 1994. So we think that this upward pressure on wages is likely to continue going forward. Again, some people may be skeptical whether that's positive for equity investors, and indeed I would say that I think that probably a more discerning approach in terms of the companies that we choose to invest in, those with pricing power in order to be able to pay for those wages, who occupy, again, I say, strong niches within supply chains, etc. If we find the winners in the economy who can pay for these prices, I think it really drives the positive cycle, and we as equity investors can also benefit from it. And if you look at the chart on the right there, we've also done some work, looking at the correlation between wages as well as CPI. So you can see the clear filter through to prices. The second point is capex. So I explained, a little bit about this. So essentially, the companies in the private sector have been underinvesting, essentially cost cutting on the prospects of lower sales growth prospects, and basically trying to defend the position they have as well, instead of aggressively expand. And there are a lot of rational reasons for that, given the demographics in the Japanese economy, etc. But there are a lot of elements as well of the economy where the demand is not really dependent on the demographics. There are separate drivers, and we're trying to capture some of this with the fund. So one example would be digitalization. So Japan, despite having those global champions, including Sony, etc., in the more electronics and digital industries, the level of digital literacy, etc., in the country, and I've been, I would say I've experienced it firsthand, is actually probably one of the lower levels worldwide. So there's a huge push at the moment in order to raise labor productivity, as well as I would say, control costs in terms of investment into software, into solutions for human resources, etc. So there are a lot of opportunities that are created by these demographic challenges. But the main message on this slide is just that the capital expenditure as a percentage of GDP is back at levels not seen since the 90s. In fact, above those levels. And this is as a percentage of GDP. So, GDP has grown as well this year. So, CapEx is a really strong force in the economy going forward. And it's also really important for us as equity investors. On the next page, this is just, outlines some of the plans for CapEx going forward. I think the interesting point here, really, if we look at the bottom, the red squares, you can see that for 2023, for the fiscal year through to April 24, we have growth in both manufacturing as well as non-manufacturing in terms of CapEx for fixed investment as well as for software investment. And again, the fund is positioned to be able to be to capitalize on this, to be able to capture some of this new pool of capital that's being deployed in Japan at the moment. The final point really is corporate governance and changing corporate behavior. And corporate governance is one of those things that, it sounds a bit like semantics. So essentially, it's essentially management of companies. So companies, do they have adequate management structures? I mean, it's not understandably necessarily the most exciting part of the landscape, I would say, in most countries. However, I think Japan is probably an exception here, and this is because of the kind of low base, the low level that we're coming from, and the potential upside that we see as equity investors. So this chart shows the dividends and buybacks, so the shareholder return that investors have been able to enjoy in the Japanese market going back through history. You can see massive improvement after pretty much 2013 to 2023. So pretty close to a doubling of the dividend. Still seeing dividend growth of around 10% a year at market level in Japan. And again, pressure is actually increasing on companies to not just increase these payout ratios, but also to make productive investments and to secure the profitability in the changing world going forward. So the final slide here just highlights one of the important, I would say, developments in the market this year, which is the Tokyo Stock Exchange. So where all the companies are listed in Japan, essentially said, if your company is trading at too low of a valuation, so it's a measure that we use called price to book, which measures how much, essentially, what is the share price of the company versus what it is supposedly worth. So the assets of the company. And many companies in Japan actually trade for less than the entirety of the assets. And so, we see as equity investors, actually, often this can be a mistake that the market's making, and, it could be a good opportunity to earn extra return for our investors. But now we also have this kind of top-down pressure from the stock exchange itself, which is strongly requiring companies with ratios persistently below 1, so whose share prices do not properly reflect their assets, to do something about that. And one way to do that can be pay out some of the excess capital on the balance sheet. It's good for equity investors. Another way can be productive capex, and again, it's good for equity investors in the right sectors that benefit from that capex. So I think it's really a win-win scenario in the market at the moment. If we look at how the fund is positioned to benefit from these trends, so in the terms of the near term, we do have some holdings in the portfolio that benefit from the pent-up demand in the consumer sector, consumer discretionary sector. We have actually some companies that benefit from the weak yen in terms of global champions in manufacturing. But I think what is more interesting potentially is the long-term scenario. The fund seeks to I would say deliver a sustainable return for investors over a long-term horizon. We look typically at company prospects over at least the next 3 years. So we're looking to identify and reliably capture return from winners in the economy who are positioned to benefit from the secular trends. So one of them, could be the deflation story. How do we benefit from that? Well, through consumer industries, so more personal consumption, massive capex. Interesting, story here in terms of companies catering towards the labor shortage here in Japan. So companies specializing in providing human resource solutions, hiring, as well as very specialized personnel such as engineers in order to run and maintain the factories and so on that are being built as a result of the capex. And again, the corporate reform, corporate governance reform as well is another point that we're benefiting from. Something else I want to talk about is also the idea of small giants in a global market that the fund seeks to invest in. And these are typically companies in the manufacturing space, but in very high margin areas of it. So electronic components, electric materials, machinery, these types of strong companies globally with strong market share in their specific products, as well as with access to structurally growing markets. And I'm just going to talk about a couple of examples from the portfolio. But first of all, let's look at maybe a couple of reasons why investors might want to look at small caps in the first place. So this is actually the index. This is the Japanese market, essentially broken down into the blue line, which is small caps, the red, which is mid caps, and the green, which is large caps, and the dotted line is the topics index, which is like the broad index essentially for the Japanese market. So you can see that strong outperformance from small caps. Why is that? Well, it tends to be small caps have a lower base in terms of sales and earnings, so they can grow at a faster rate, and that is typically reflected in the share price over the long term. Another reason why the small cap market is interesting, particularly from active investors' perspective, so from stock pickers' perspective, is that there are very few analysts covering it. And if you look at the graphic at the bottom of the screen there, you can see that the small cap index, so that the blue line from the previous screen, just one sell-side analyst actually covers, on average, a company in this space, and it's over 3,000 companies. And also, over the past 10 years, we've actually seen the number of analyst coverage come down. There's been very much a pull away from Japan. I think it's created even more opportunity, especially for dedicated, investors such as SMDAM, who have a local presence in the space and are able to understand and know where to look with these companies. Something else that's really interesting, I think, about our portfolio and perspective is that we have good exposure to the domestic demand-driven growth story that I talked about earlier in the presentation. So the way that we read this chart is our portfolio is the United Japan mid cap portfolio, and you can see that compared to the large cap index, the topics, we have far fewer companies that rely on revenue from foreign sources. So ordinarily that would be potentially in a fading economy or a mature economy such as Japan, it would be interesting to look at more of a foreign revenue driven I would say characteristic in the portfolio. But at the moment there are some real compelling growth stories, as I said, in the Japanese economy that are very idiosyncratic to the rest of the world. So not linked to the property issues in China, not linked to a potential slowdown in the US, but more like a domestically driven growth cycle. And so this fund offers excellent exposure to that side for investors. So I want to go through a couple of names just to add a bit of color. The first one is a name that benefits from digital transformation, and the name is JBCC Holdings. So when we talk about tech, as in software, certainly for me as well, the first thing that comes to mind is not a Japanese company. It would be, one of the tech giants with scale, etc. But there are some really niche companies that cater to the needs of particularly the small and middle-sized companies here in Japan. And they make up actually in terms of the market, 98% of the companies in Japan are small and middle size in terms of the employees that they employ. So it's a large marketplace. It's large in terms of potential sales, and so this company has a subscription based revenue stream. Essentially, it provides security solutions, or development solutions, etc. Tailored towards particularly the smaller companies here in Japan. And competitive advantage is obviously it's more agile, more able to take on bespoke and potentially lower ticket, I would say, projects than the larger companies, as well as having also come from the expertise in originally starting actually as a wholesaler of IBM equipment. So it had a network of companies that they work with here in Japan. You see the stock price on the left there. It's been a successful position year to date. The manager and the team invested in this one actually. It being a small company in the market, it wasn't clear quite how this company had actually transitioned its business model. So the market was still pricing it as really a project-based, I would say more of a cyclical company. And again, what tied to the office, IT equipment providing, so maybe stable revenue, but not high growth, not recurring revenue, etc. It transitioned successfully. And when we saw actual contribution coming through to the earnings, the stock price has reflected that quite nicely there. You can also see that the operating income has grown its margins successfully too on the left there. The next one is Okamura. This one captures the evolving work styles in Japan. So this one actually originally does office furniture, but a much more interesting part of its business is actually around the idea of office environment transformation. So catering towards a more hybrid working style. At our office here at SMDAM, actually we kind of redid the office recently, made it, I would say, more employee friendly, more conducive to productive work. And this company, has its own team of designers. So it has basically an integrated supply chain and enjoying that post-COVID work style reform that's been supported on the policy side as well here in Japan. Tapping into a real new demand in terms of transformation of workspaces. So why was this one cheap? Well, products, for this one, overseas driven basically cost push inflation of last year. It saw effect on the bottom line of the company. However, with the top line growth as well as the positioning in the sector, so able to set the price level essentially, it's passed through the cost successfully, and we're now seeing the stock price appreciate. You can see on the right as well a good story in terms of the operating margin of that one growing through time as well. The final one that I want to talk about is potentially the most immediately relevant just now. This is MEC. And many even Japanese, I would say, would not have heard of this company, but it's actually involved in the semiconductor value chain, and particularly in terms of a very kind of difficult to replicate process whereby copper is applied to surfaces, so circuit boards, etc. And it's involved in the packaging segment of semiconductors. So it sells its customers, the customer of its customers are places like Intel, AMD. So this one is benefiting from the secular demand for servers, etc. Given the whole generative AI story. And again, the valuation was cheap, facing massive selling after challenging environment last year. So this one was a real opportunity to pick up earlier in the year and hold for the long term with the fund. So the team behind the fund, we have two fund managers, both local experienced fund managers, and also supported by I would say an industry leading team of analysts as well on the right hand side, in order to really uncover the diamonds in the rough in terms of the market here in Japan. And I was talking about the opportunity set here is huge, over 3,000 small companies, and these two meet. On average, they have, I think, around 1,000 meetings in any calendar year with the companies direct. It's sometimes difficult to actually access these companies in the market with the language barrier, etc. And they have, a proven track record as well. So just lastly, I'll look at the performance. So the historical performance of this fund versus the benchmark, which is a representative small and mid-cap index, the MSCI index, we've outperformed by 78% there over the long track record of the fund, the nine or so years. So I think that the talking about the opportunities we see going forward, as well as a track record, I think it's a potentially interesting thing to look at for an investor looking at Japan now. But this year, I mean, the story in the Japanese market has really been large caps, first of all, and that's been driven by primarily by, well, a couple of things. One is the weak yen that we have here, and the more important one is probably the effect that that's been having on the earnings of these companies, as well as the kind of the supply chain issue resolution that we've seen, particularly in the auto sector. So that's been benefiting large caps so far this year. We talk about small caps, particularly in those very exciting areas that benefit from sustainable long-term secular demand in the Japanese economy, as well as pockets of demand in the global economy. We think that small caps are an excellent alternative to large caps going forward. Large caps already appreciated quite a lot. This chart here that I just want to share with you before we go to Q&A is it basically shows the green line is the ratio of the price of large cap stocks, which is the Nikkei index, so the very familiar, the blue chip index, versus the small cap index. So that index we just looked at on the last screen. And near the bottom of the screen, basically, it means that the level of prices for these names is now discounted. It's as cheap as almost as it was during the pandemic. So when many of these names faced very real issues of continuity, etc., the market is discounting this segment of the market as much as that at this point in time. We think that is not warranted, particularly not on a more micro level when we talk about specific elements of the market. We're not making a call on the small cap market itself. There are many low growth areas of the economy, many companies that in the industry we call value traps, so companies that appear cheap but are actually not. So we really think that a discerning approach is something that investors could consider in looking at this exciting opportunity set going forward. So I'll leave it there, and I think that we have some questions. So if I hand back to the moderator.
Thank you, Mr. Alexander Hart, for your insightful presentation. Now we will proceed to the Q&A section. They have a few questions over here. The first question is, do you foresee Mrs. Watanabe having an effect in Japan, example, investing domestically rather than abroad?
Yeah. So the Mrs. Watanabe was coined, I think, particularly for Forex investors. So if we go back to, I think, probably the 2000s, we saw the idea was that the Japanese housewives, although in Japan many the housewife is actually quite rare now. Many we have dual income households is probably the norm, which is actually supporting some of the factors I think I talked about in the presentation. Just an aside there. Yeah, so we had essentially looking to the financial markets in order to derive a return. The answer to the question here going forward with the equity market is yes. I think that yes, it is there's a very real prospect here, and I want to talk about a couple of reasons why. The first one is if you look at the amount of cash on balance sheets of the non-corporate sector, so the households in Japan, it's over 1,000 trillion yen. So it's a huge stock of cash that is not being used productively. Typically, some of this, would be invested abroad, but there are a couple of reasons why domestic investors are, I would say, actively looking at investing in Japanese equities now. The first is income. So there are a number of strong dividend-paying stocks in Japan, particularly in like the financial sector, etc., which have been very cheap. So we see good demand for stocks like that. But I think the more exciting thing potentially is that next year, starting next year, we have actually a new tax incentive for investing. So in the UK, where I'm from, we had ISA, which is basically a tax-free wrapper. I'm not sure in Malaysia, I suppose you have a similar, but the one in Japan, until this year, the amount that you can invest tax-free in 1 year is just 1 million yen. So it's like $5,000 US. From next year, that's being rising to 3 million, so triple the amount, and they're also removing the time limit. So it used to be, from my perspective, as I would say a balanced or with no bias to, in favor of it. I don't think it was a useful tool, but going forward, it will be. And so particularly for investors looking at how to cope with inflation going forward, how to save for retirement, I see strong demand from individual investors here in Japan for Japanese equities going forward using that tax wrapper. The other thing is the pension funds here in Japan are also looking at a more efficient, I would say, allocation in terms of their assets, and that includes looking at particularly new segments of the Japanese market, including small caps. So there's healthy demand for Japanese equities from Japanese investors here, and we can see evidence of that. I think where the market sold off in the past couple of days or weeks, we've seen strong supportive buying from individual investors. So I think that there is very, very strong demand there. And just to put one number to it, if I can, before we go on to the next one, the 1,000 trillion yen, if just 1% of that went into equities, that would be the same as all of the share buybacks. In fact, more than all of the share buybacks for a whole year in terms of demand in the market. So, it would be a considerable force for prices in the market. That's just 1%.
Okay. Well, another question is, what is the difference between buying a mid or small Japan index fund versus your United Japan NS fund?
Yeah, sure. That's a really important question. And so both an index fund as well as our solution would offer primarily exposure to domestic demand in terms of the companies in the portfolio. Where the difference would lie is the index also includes a lot of, I would say, low growth areas of the market. So there are some really positive factors for Japan at the moment that we've talked about throughout the course of the presentation today, but I don't think it's going to be a case of like a rising tide lifts all boats. In fact, I think that particularly for active investors, there are going to be more opportunities in stock picking than just in the market. So one area that we still see challenging, I would say, in terms of a sustained return going forward is we call it defensive areas of the market. So segments where the cash flows don't vary very much, for example, in a recession, as opposed to a normal market conditions. But then the growth prospects are also not great. So a good example would be something like utilities. Another one, we could talk about consumer staples, this type of areas in the market. So essential, and you would have exposure to areas of the market like that through an index, as well as financials. A lot of regional banks in Japan are actually listed in the small cap index. That's similar to the US. If we look at something like the Russell 2000, so the small cap index, and again, we may see a marginal increase in the interest rate, but I think it's still going to be a challenging environment for such an overbanked, society to continue on the current trajectory. So we may see some M&A. There may be some opportunities within that, but I think that taking more of a discerning approach is potentially the more interesting way to approach the market at this point in time.
Okay. Another question is, United Japan Discovery has explosive growth this year. Would it be recommended to get in now, or there may be a correction due to Japan's small mid-cap market?
Yeah, sure. So it's again a good question. I think in terms of timing the market, really we had like I would say one of the major risk events that we had in the market recently is the BOJ. So the BOJ essentially, particularly for small cap companies, what the BOJ does with the monetary policy seems to really affect. It can have implications on things like valuations, on the future cash flows of companies, etc. And so it's really seen as a major risk factor in the market. We just had the monetary policy meeting of the BOJ the other week. So I would say that the main risk factor in the market at the moment is gone. So I don't think that we'll necessarily see downside at the moment. And I think that especially given the fact that small caps have been lagging large caps, particularly this year, and a lot of that has been driven in the case of large caps on by the strong exports. I think as we see maybe global growth slow down due to the higher interest rates, we should see smaller mid caps continue to benefit. So I think now would be a good opportunity. And I think if you look at the last slide, this isn't our fund specifically, but this is the the index, and it shows that the magnitude of difference in the pricing of large caps versus small caps. We think that there's ample opportunity to still for investors going forward.
Okay, for another question is, with expectation of higher capex and investment for growth by Japanese company, wouldn't dividend payout by negatively affected in lieu of growth?
Yeah, absolutely. That is essentially the correct assumption. So the thing that I think is most significant about looking at the shareholder return is that it's evidence that corporate governance now works in Japan. So it didn't used to be the case that equity investors had a voice essentially, and this is obviously important for things like the dividend, as well as enjoying shareholder return in the short term, but it's also important in determining the management of companies. So we can now vote. Previously, companies' stocks typically were owned by it was called cross holdings. So banks would own stocks, suppliers would own stocks, and minority shareholders would not have a voice. So I think while the level of shareholder return increasing has been something certainly affect the effect of better corporate governance, the important thing to look at here is the corporate governance itself. The second thing I would say is that our fund in particular does not seek as a primary objective dividends. Many of the companies do pay dividends, and there is a misconception actually sometimes that small companies don't pay dividends, whereas in fact they do, and the dividend yield is around I think 3% on the fund. So it does have a healthy dividend ratio. But we're really looking at the companies with able to invest. Dividend essentially means that you don't have viable growth prospects for all of the shareholder capital. So we're looking at companies that really can pay for their growth with their cash flows. So they're not going to the debt markets, the equity markets to finance that, but they are, they do have growth prospects and projects going forward. And so I think that the answer is yes, it may negatively affect the dividend, at the margin for the economy as a whole, but it's not going to be something that is I would say, relevant for us with the fund. And similarly, I would say that Japanese companies can really afford to pay dividends. So the balance sheets in the corporate sector are extremely healthy. We have about 500 trillion yen on the balance sheet. Again, many of that in companies with net cash, so no debt, so they can just pay straight out to shareholders. So I think that yeah, it's a valid point, but I do not think that it's something we need to really focus on for the fund.
Thank you, Mr. Alexander Hart. Due to the time constraint, I think can I ask more one last question for you?
Absolutely.
Can you also comment on the aging population in Japan? Do you think it will cause labor shortage in the future?
Yes, the answer is 100% yes, it will. And there's been some, a study done earlier this year by a think tank here that suggested that by 2040, we're looking at actually 11 million, worker shortage, and that's going to hit, certain sectors more than others. So I think that if we look at the areas that we're invested in with the fund, so I'll give you an example of a name called Maytech, which does actual human resources. So it's providing solutions, helping companies to find workers, for example here, and then these companies are going to enjoy a premium going forward on the services that they provide, because it's essentially it's becoming a seller's market really for that. So on a macroeconomic level, I'm not going to sugarcoat it. It's not a positive. It's not good demographics, but it does create a lot of opportunities in areas of the economy, and particularly with small caps, we find, because of the lack of analyst coverage, the lack of understanding in the market, that these companies really aren't appreciated. And so I think that it really does, the fund looks at where this creates opportunities. And the other thing is that demand is probably not going to change that much. So there may be a fear that consumer demand is going to come down, but I mean, demand's going to change. Like we'll see more demand for for example, end of life care, for services as opposed to goods. And again, the fund is positioned in order to be able to capture that trend as well. But I think that, yeah, it's another reason why really I think an active approach is good in the market, because you can adapt to the market as it changes. And I think that the index, it being very much focused on more of the old economy type firms, I'm not sure is in such a good position, particularly not with the small cap index. Thank you for that question, and thank you for all the questions. Very, very insightful again.
Thank you so much, Mr. Alexander Hart. Ladies and gentlemen, this would be the end of our Q&A section. And then thanks again, Mr. Alexander. A replay of tonight's section, right, will be available right after this. Please proceed to our Facebook page, FSM Malaysia, to catch this replay. Once again, thank you very much, Mr. Alexander Hart and the team. And thank you everyone for attending tonight's section. Good night, everyone.
Thank you very much.
Thank you.